We all have a massively distorted view of investments. We all have a massively biased view on stocks, on crypto, on gold. We all denominate things in US dollars because this is how our life works, right? All products are denominated in our local fiat currency. Most contracts are fixed in the local currency. So that could be US dollars, could be the euro, whatever it is, right? We all have our focus on our local fiat currency. And this is practical in commerce. It's incredibly unpractical in investing because unfortunately, one of the major drivers of any investment is liquidity. And liquidity fluctuates massively up and down. That's why on a given day, we see that all stocks go up at the same time, all stocks go down at the same time. Everything is super highly correlated. No stock does its own thing, apparently. And there seems to be this one hidden hand that's moving everything. So, of course, there are outliers, right? There are some stocks that suddenly shoot up and others that suddenly shoot down. But the vast majority tends to be moving in the same direction at the same time. That's true for stocks. It's also true for crypto. And that's a problem because when we just look at US dollar valuations, our whole view is completely distorted by that liquidity. We're actually not looking at the investment. We're just looking at an expression of how liquidity is developing. So what ends up happening is that you want to determine something, let's say the value of a company, but you're not actually looking at the value of the company. You're just looking at the liquidity going up and down. So that would be like a farmer that tries to find out how much product did I produce? And instead of counting the product, they might be counting, say, the holes in the ground. So they might look at the past weather report, see, okay, the weather was pretty good. Thus, I believe that I produced enough. That's kind of similar to thinking that a company is performing well because the stock is going up. But the stock might have only gotten up because more liquidity is coming in. This effect becomes a bit more tangible with the crypto market, right? We know that there's a lot of liquidity flowing in and out of the crypto market due to the Bitcoin ETF. So let's say there is a day where a ton of capital flows into the Bitcoin ETF because let's say a huge endowment or a huge institutional investor decides to put Bitcoin on their balance sheet. A lot of capital gets into the Bitcoin ETF. What will happen in all of crypto? Everything will go up. Bitcoin, of course, will appreciate, but your random AI meme coin is also going to go up. So you're happy about your AI meme coin going up, making money, but that has nothing, zero to do with your specific coin. It's simply just more liquidity entering the market, elevating the prices of everything. That's a main driver of all prices. And that's a huge problem. It's a problem that we've got this fiat bias. It's a problem that we've got the US dollar denomination bias. It's a problem because it's very handy in commerce. It's very nice as a habit to have. It's nice to think about, okay, I'm at that many US dollars and that's equivalent to say 1 or 2 months of my income and I can buy XYZ with this. It's useful for these comparisons, but it's completely not useful to determine how well you're actually doing. So fiat prices in commerce are very stable. Fiat prices in investing are incredibly unstable. We have to look at other denominations in investing to take away that liquidity expansion and contraction. So what I personally do is when I look at my stock portfolio, I actually don't look at the US dollar price. I divide the US dollar price by the NASDAQ 100. So I know how many NASDAQ 100s I have. I don't know how many US dollars I have. At least I don't really look at this, right? I've got my Excel sheet and then I put in the US dollar amount. I put in the NASDAQ value and I update this every month. And then I know, did I actually gain versus the NASDAQ? Do I actually own now more of the stock market? And this way, I'm completely removing those ups and downs of liquidity expansions and potential crunches. The same is true for my crypto portfolio, right? I don't look at my crypto portfolio in US dollars. I look at it relative to a benchmark that reflects the liquidity expansions and contractions the best. And that can be for crypto, either Bitcoin or Ethereum, depending on how many altcoin transactions you do. If you've got a ton of altcoins, you might even do this relative to Ethereum. I personally measure my crypto portfolio in Bitcoin. So simply by seeing, do I now own more or less Bitcoin? By dividing the overall crypto portfolio value by the current Bitcoin price, I am eliminating those ups and downs. And this is, in theory, what should be working, right? There's even the saying, 1 Bitcoin is 1 Bitcoin. But then I also get the rationale why some people say, 1 Bitcoin isn't necessarily 1 Bitcoin if I want to cash out and buy something nice with it, right? If Bitcoin versus the US dollar goes down by 60, 70%, then yes, 1 Bitcoin is 1 Bitcoin, but that's only true over long periods of time, right? Where the volatility cancels each other out and where in the end, Bitcoin rises over the long term. If I want to use the purchasing power, now suddenly the US dollar valuation becomes very important. So there's this theoretical argument, right, that we should look at everything just denominated in Bitcoin, but there's also the practical argument, which I can totally understand, that we want to have more US dollars. We want to use that in the real world.
This video is sponsored by the Premium membership. I never take any money from any crypto project. I never take any affiliate links from centralized exchanges. I never pump and dump coins. Instead, I offer valuable tutorials in the Premium membership. Feel free to check it out.
And so there's actually a solution to all of this. There's actually a way to make money with altcoin trading, for example, without being dependent on the US dollar denominations. So most people simply just buy altcoins, say, on a centralized exchange. They've got their fiat, they deploy their fiat and buy a random altcoin, and then they are exposed to the liquidity expansions and contractions. And you might have picked the right altcoin. If liquidity contracts and if oil prices are going down, then your specific altcoin that you bought is also going down. And so that's a problem, right? You might be the best investor in the world. You might have bought the top 10% of altcoins, but they still might all go down, or most of them might be going down simply because Bitcoin is going down, simply because, say, an institutional investor decided to exit the crypto market and sell all of their Bitcoin ETF. It has nothing to do with your decision. It was simply just the overall liquidity that overshadowed everything. And this is a very, very strong effect. US dollar prices are super highly correlated. So here's a solution to all of this. And the solution is super important, especially in the current market where we are pretty much in limbo, right? It's very hard to say if we're going to go up from here or down from here. We're already relatively high. Momentum seems to be dying down. So there is some upside, there is some downside. It might make sense not to be super heavily exposed to that liquidity expansion and contraction. There is a solution, and that solution is delta hedging. So what you're doing is you're betting on an altcoin to outperform another altcoin, relatively speaking. You are not betting on the US dollar valuation at all. So you can bet on one altcoin to do slightly better than the other altcoin, and you make money, even if both altcoins go down. So let's say you're bullish on altcoin A, and altcoin A goes down by, say, 5%, but altcoin B is way worse, and it goes down by 50%. You would still make money. You would still make 45% gains if you neutralize delta. So the overall direction of the market is completely irrelevant to you. The only thing that's relevant is how is one asset doing relative to another asset. So what you're essentially doing is you're longing one asset, you're buying one asset, and you're shorting the other asset. You're betting on falling prices of the other asset. If you then make this a bit more fancy, you can even beta adjust this. So you can adjust this by the historical volatility. So let's say one asset tends to be much more volatile, tends to go up and down much more versus the other asset. Then you could, in theory, buy this in different proportions to one another, right? Buy less of the very volatile thing and buy more of the less volatile thing so that the volatility really cancels each other out. So you can measure this even with beta, but that's already pretty advanced. It's not necessarily that important if you somewhat have similar kinds of assets, right? The main thing is to at least eliminate most of the liquidity exposure. And that is simply by shorting one of the assets, right? And now think about this fundamentally. You don't have to anticipate anymore where the overall market is going. If you have got a very strong conviction that there is, say, a sub-market, right, in tech, and you believe, say, that Apple is super likely going to do much better than Samsung. Just an example, right? Probably it's better to do this with smaller markets, right? When you've got this with smaller markets, there is way less diversification, etc. You can get this clearer. If you have a strong opinion on who is going to win in the market because you are very well informed in that market, again, you do not have to suffer just because all of stocks are going down. You can make money with this simply by buying the thing you're bullish on and shorting the thing, betting on falling prices of the thing you're bearish on. And the overall market can go up and down and in circles. It does not matter as long as your favorite is doing better than the thing that you believe is a pretty crappy company or asset. In decentralized finance, in crypto, in DeFi, it's actually very straightforward to set this up. In traditional finance, not necessarily that simple because you can't necessarily take the collateral after you've shorted something and reuse that capital. It's less capital efficient. You also need quite a few tick boxes on your brokerage account to be able to short all kinds of things. You also might have a lot of hidden fees. With DeFi, things are very transparent and the fees also are pretty low. So you can, for example, borrow the asset that you are bearish on, take those borrowed funds and then swap that into the thing that you're bullish on. And then again, you've never really had any exposure to overall liquidity. If your collateral is just stable coins, right? The stable coins don't go up and down. It's just Tether, it's just USDC. That's your collateral. You borrow against this a certain asset that you're bearish on. You've got the loan denominated in that asset. Then you've got the asset, you swap it against the thing you're bullish on. And then the thing you're bullish on outperforms the thing you're bearish on. Then you can swap back at some point in time, pay back the loan and have, again, some of the assets that you didn't have to swap back because the valuation outperformed. You've got that then as your profit. Approaches like this are, of course, a bit more complex to say just going on Maxi or going on Binance or Coinbase and buying the altcoin with your fiat. But again, right, we want to win irrespective of market conditions. And for that, we have to delta neutralize. And for that, we have to learn how to do this. And the nice thing about this is when our portfolio does not crash while all the other portfolios do, then we can pick up the pieces in case of a crash. In other words, we're actually kind of happy that a crash occurs because other people get forced liquidated. We see massive lower prices. For example, with Corona, right, during the COVID crash, Bitcoin went down more than 60% in 2 days. It's actually pretty good. If we are delta neutral, we made some money beforehand with all of those relative valuation plays. Now our portfolio is still in the green. It's still not going down because we completely hedged against this. And then we buy those lows. So actually crashes are an advantage for us. They're actually good for us because it gives us opportunities that most people can't take advantage of. And this gives us, of course, a step ahead in the game. So US dollar prices are completely deceiving in the investment world. They're nice in commerce. They're nice in short-term transactions. They're completely useless when we look at asset performances over many years. In the short term, they can also be useless if we delta neutralize. So we can make money simply just by saying this performs better than that, completely irrespective of what the market as a whole is doing. We can completely decouple ourselves from that, which is very advisable during times like this, right, where we are not obviously cheap or obviously expensive, say, in the crypto market. Because there is a bit of a learning curve to all of this. I have, of course, also made tutorials on this, but I don't post that on YouTube because those kind of videos don't get a lot of clicks. And of course, I want to make a bit of money on the side as well. So if you want to know how to set this all up in DeFi, feel free to check out the premium membership. So that's down below. It's thebitcoinstrader.com. Feel free to check it out. And of course, if it's your first time here, feel free to subscribe as well. I publish videos regularly. The like would be very much appreciated as well. It helps the channel grow. See you next time. Bye-bye.